Hello and welcome back to the Redhedge Podcast. Today I'm here with Yusuf Özdalga, partner at QED Investors. Welcome, Yusuf.
Thank you. Nice to be here.
Thank you very much for taking time. Why don't we start by telling us about QED and what you guys do?
So we're a global VC, early stage fintech fund. So we invest in Series B, Series A, seed, sometimes earlier, sometimes a bit later. And we also have a growth fund, but exclusively fintech across the globe. So we started in the US. We were set up by Nigel Morris and Frank Rotman. Nigel was a co-founder at Capital One, which at the IPO was 1 billion market cap in 94, and then grew to 20 billion in 10 years to 2004, and now has become one of the top 10 US banks. So the idea with QED was to use the insight, the knowledge, the experience, the connections we had from the Capital One experience and add to that by adding non-Capital One people to QED and some Capital One people to basically help companies in the fintech space. And back in the early days, fintech was not a word. So we called it companies that use data to compete and win in financial services. Fintech is a much more catchy phrase, so we like calling it a fintech now. And we've made many investments. Started in the US originally, then LATAM, where our first investment was Nubank, then Europe, which is what I'm heading up for QED, then Africa, India, and Southeast Asia. So we cover the vast majority of the world for early stage fintech.
That's very interesting. Thank you very much. And because you anticipated this, but fintech is a bit of a word now. Everyone does fintech. How do you filter out? What is fintech to you?
Yeah, I mean, for us, it's pretty broad because we've been now investing for about 15, 16 years. It started fairly narrow. So some of the early wins we had, which are pretty notable, is Credit Karma, for example, and a similar company in the UK called ClearScore that I'm sure a lot of our listeners are quite familiar with. It was very much around consumer credit, lending, and so on. We've actually gone quite a bit broader since then. So we've done things in insurtech, we've done things on the capital market side, we've done financial infrastructure, we've actually even done things in proptech and e-commerce. So we have a pretty broad definition of fintech, but in general, it's credits, it's lending, it's payments, it's wealth management, it's all the classic things around money.
Interesting. Yeah. I mean, we talked about this in our previous podcast, and I strongly believe that right now there will be the biggest exchange of wealth between generations. And one of the reasons why I was glad that you could come today is because we particularly care about this in every single aspect, not only about investing, but about how the world will change on the back of this. And I guess the fintech world, it is obviously the core of this, because we know the older generation has a different way to manage assets, not just cash investments, but assets overall. The new generation is different. It's always difficult to speak when you're, about catalysts like that with your parents, and at some point, suddenly, a lot of people with the new mindset will have to manage assets.
Correct.
And so this is why I believe fintech right now is more meaningful than it was before. It's very important. And so in general, what I've been asked and we've been talking about over and over again is AI. And obviously this is the topic of the year, the topic of the last couple of years. And I strongly believe that right now AI is being used as a marketing tool rather than the real thing. I mean, for instance, we've been using machine learning in our models, we are a quant fundamental strategy. And in our quant side, we've been using machine learning from the very beginning of our journey, but we almost crucially use the word AI now because it became, we don't want to be labeled in that kind of bucket. But how do you filter out between AI from marketing and AI for real? AI is that for sure, I guess. Yeah. But what is AI for you? Yeah,
I mean, AI is exciting for us in a nutshell. We are also cautious, as you say. So there's been many examples in the past. Cryptocurrencies is probably one where there was a lot of innovation, blockchain, Web3, etc. A lot of exciting things, but we were cautious. Initially, we were probably a bit more skeptical. And as we kind of looked at that space, we said, there's some real change, real innovation here. And then we made some investments that have been actually quite exciting for us. So I think similar with AI, there's a lot of hype around it, for lack of a better word. It's a bit like a gold rush, right? So in any gold rush, there is gold. Some people get rich. Some people get rich finding gold. Some people get rich selling shovels. But also a lot of people lose their money or get robbed or get lost in the wilderness looking for gold, right? So I think AI is a bit of that for us, that we're like looking at it and thinking about the implications in fintech. In fintech, there is a lot of implications, actually. I'll just touch upon two here, and there's many more. One is on the regulatory side. So this is almost a challenge, I would say, which is that regulating AI is very hard. And fintech, different from other fields in tech, I think is regulated in a very specific way. Consumer interest, SEC, how do you protect consumers? How do you protect retail investors? And that brings a lot of political regulation. And when I say political regulation, I mean regulation with a lot of sort of media pressure in the background to make sure consumers are treated fairly. Hence, politicians care about this. And that makes regulation quite difficult. I mean, what happened in 2008 and the regulation afterwards is just one example of this, very, very salient example. And as a result, AI will have to be regulated. And when it's regulated, it's very difficult for the regulators to wrap their head around it because just to pick a simple example, machines, when they speak, they may have hallucinations, as we know with AI. They don't say the same thing twice. It's not very predictable. If you have a very complex model, understanding why the model recommended what it recommended or said what it said or produced what it produced or declined who it declined, why did it do that, becomes more difficult. And these are all regulatory questions. And they're genuinely difficult on the one hand, but then on the on the other hand, they're also even more difficult for regulators because they move in a very different way. So just to sort of summarize the point here, I think regulation of it is going to be very difficult. It's going to slow things down. It's going to create friction, and it's going to pose some challenges. The second point, I think, on AI, it is going to create tremendous opportunity. So we have many examples of this, but one that's very relevant for the podcast today is like wealth tech, right? So wealth tech is a vast space, one we're quite excited about and we can talk about a lot. AI can really transform this. Let's pick one interesting example. If you look at trading platforms like a Robinhood or other one, which is a bit more like a mass trading, day trading, whatever you want to call it, there's a lot of decisions being made by day traders or retail investors, and not all of those decisions are optimum, right? So you guys are a hedge fund, trading biases very well. I'm sure you have coaches that come and tell you, Andrea, as your, trading has this bias, here's how we can correct it. Well, AI opens up the door to be able to do that at a mass scale. So to tell people, listen, I've analyzed your trading history for the last 5 years, and you sell too early. Or you buy based on news stories when the upside is already priced in. And, rather than giving direct advice, they can say, are you sure you want to do this trade? Are you sure you want to sell right now? Because looking at your past data, I realize you have these biases. And that's something a coach could do, but it's quite expensive. AI can do that very cheaply by learning from your past 5 years of, retail trading data on Robinhood or eToro or whatever platform you may have been using.
That is very interesting angle. I haven't heard this coaching substitute angle. Of course, a pattern between, whatever they've been doing, retail, they go a bit of against the logic and a professional and institutional investor will do in buying and selling. For sure, it's something I listened and heard about. But in terms of coaching yourself and self-improving, it is a different angle that is actually. Do you know someone that is actively starting to provide this kind of service? It's more like hypothetically in the future.
Yeah, I mean, well, we're talking about it. So hope would be that we'll bring something soon. Either we'll invest in a company or help some founders do it, or look at some of our existing investments. So the first step for us VCs is to get excited, talk, and then the end product hopefully materializes in a year, months. A few years, we'll see. But yeah, we're definitely working on these things.
One of the challenge, I think, and correct me if I'm wrong, is the due diligence. I mean, if you have a great idea, and obviously that, like anyone can have data, and a lot of data is very difficult to be checked, as we know. How do we approach the due diligence? How to verify that the deal is real with that specific company?
That's a great question. I think that's one we talk about a lot. I think the first step is intellectual honesty and being honest with yourself. What are we good at? What are we not good at? So obviously we invest in a lot of very exciting tech companies, but at our core, we always joke that we're a little bit more fin than we are tech. So I think we would be quite unlikely to invest in a pure tech play. So if somebody said they're developing a pure tech engine or a AI or Gen AI model that's going to be sold, that would be unlikely to be a great fit for us. Where we would look instead is, where is AI disrupting an industry or a business or a segment or a vertical? And from that disruption, what kind of companies may succeed, and can we invest in those companies? And to take that yet one step further is, with those companies, we tend to choose the seed or Series A stage, because we actually then have some tangible results and we have some customers we can talk to. So rather than going through some Gen AI model code by code, or questioning the model, etc., we actually look at the customers and look at the end result, the financial result, the NPS score of the customer experience. So we do look at the business side of things much more. Obviously, there are much more deep tech investors, but that tends to be not us. We tend to go more for the business case and the sort of result of the tech disruption, which there's plenty of. And there will be a lot of, undoubtedly, from AI.
I guess it is almost impossible, in short, to check the code by code lines, and even who specializes, who is more tech than fins, will be struggled to spot.
Correct.
And obviously, a track record, I guess, is the main protection. As you say, you invest a bit later, you maybe leave some money on the table for this reason, but much safer. So the risk level is much more controlled.
Correct. And all businesses are people businesses, but I think VC especially, and startups, is the ultimate people business, where you invest in the people, and whether you're a deep tech investor, you may actually look at some code or whatnot, but you still are looking at the person. Who is this? Is it Sam Altman? And what's their background? Will they succeed here? Do they have the credentials, the experience, the stamina, the vision, etc.? So it always comes down to people in the end.
That is very interesting. I agree 100% with this, because I think in any business, from very early business to very established business, people, it is the key still, and will be the key. And AI is a tool of people, for people. It is, I think, a good angle to look at it. But steering away from this topic that we I guess you and I and anyone else here talked about extensively. I was looking at your website, and first of all, maybe will you want to tell us your journey? How did you get to QED?
Yeah, definitely. So by background, I'm Swedish-Turkish. I grew up in both those countries. I always joke that my mom tried to mess me up by taking me back and forth as a child many years at a time, and she succeeded very well. And then I had the opportunity to study in the US for college when I was 18. So I couldn't decide what exactly to study, so I chose two topics, finance and MIS, so database design and database management. And that kind of positioned me quite well for joining Capital One, which was around the corner, like a 1 hour drive from the UVA campus, University of Virginia. And at that point, Capital One had just IPO'd a couple of years ago, so it was still in a scale-up phase. As I mentioned earlier, it was a $1 billion valuation at the IPO point. And when I told people I'm joining Capital One at the UVA, most people thought I meant Capitol Hill. I was like, no, Capital One. So it was relatively unknown, but growing very, very fast. It was an amazing journey. I joined Capital One thinking that it's the biggest database in the world and we'll have all this amazing data. I realized to some extent how imperfect the tech and data side of things were, and how we're using the 70s, 80s technology in some cases. But on the other hand, I also realized how some of the secret sauce was actually in the people we hired and how we organized and incentivized those people. And again, going back to the point, every business is a people business. I think Capital One was a very good example of that. And Nigel back then, I remember, used to say, we're not in the consumer finance business, we're in the people recruiting business. And that's a quote that I use often and try to keep in mind for all our startups. Capital One then started to become more and more like a bank and a bit more bureaucratic, for lack of a better word. So I think I saw myself wanting to gravitate more towards Europe and do other things. So I left in 2001. I had a 2-year non-compete, which a lot of people had at that point. So that enabled me to basically get an MBA for 2 years at Chicago. I did that. And then I didn't want to be a banker long term, but I viewed investment banking as an extension of the MBA experience to get some practical training, and joined JP Morgan's FIG M&A team right after MBA. And that so happened to be the team that had done the Capital One IPO and the main bank for Capital One. So it was a really interesting idea for me to be a banker to banks. And at Capital One, I was very much on the left side of the balance sheet, underwriting credits, thinking about, what's the profit of an account, CAC payback. At JP Morgan, I got to see the right side of the Capital One balance sheet, securitization, how does Capital One fund itself, equity markets, debt markets, and that was a great learning. So I did that for 2 years as I had planned, and then after that with JP, I actually came to London and switched to Lehman's principal investing team, which is basically building, investing in, or buying, in many cases, lending platforms. So I was sort of the ex-operator, ex-M&A guy on that team, and most of the other guys were all loan traders, which you would be very familiar with. So they would come and ask me, what's this company really worth? And I would say, I don't know, what's the loan worth? And we entered into big circular arguments. But yeah, so that was a great experience because it was very interesting actually, but then became a pretty historic experience as I lived through what happened up to 2008. After that, I started my own business briefly. I was a bit burnt out, for the lack of a better word, of that whole experience that I went through with Lehman, and did something very fresh, salt to the earth kind of business in Turkey. So that was a good break for me, and I sort of recharged myself, and being an entrepreneur was amazing, honestly. Exhausting on the one hand, but also really recharging. Met my wife during this period actually, and got married, and then as she moved to Turkey, I exited my shares to my co-founder and went into private equity, back to the dark side. Did that for 5-6 years, and as our kids were born, we decided to come back to London. I called my ex-colleagues from Capital One and said, what are you doing? They were at QED at this point, and they said, you know, we're looking to set up a European office. Good timing. So I joined 7 years ago to set up our physical presence here in London. We had been investing quite a lot before that. We had good investments like Klarna, ClearScore, Zopa, and others. And I was fortunate to come and sort of continue building on that heritage of QED here in London.
Well, fantastic journey. Looks like you've seen a lot of different sides, but the common elements is people in all of these, and having a first-hand experience as a founder, it is important, I think, to manage the investment after you actually invested, which is something I think is the main difference between what we do and what you guys do. When we invest, when we do a trade, it's done. All the work is before, and it's almost in your industry the work starts when the investment starts. It's the journey, is that way. And correct me if I'm wrong, but it feels to me that given the current rates environment and the challenge overall to find capital if you're a startup, which is obvious, and it's been like that for the last couple of years, does this filter out a bit the selection? Is the quality of startups that you see now a bit better than before? Just because, you know, a couple of years ago, if you looked at LinkedIn, everyone is a CEO. Like you didn't even finish university and you already have your own startup last 6 months, and then you are an intern at JP. Is it still the case, or is it a bit more? There is a bit more quality of that.
It's a very good question. So, I mean, I think to just take a step back, and I would assume most people are familiar with this, but what happened was there's a very good chart that tracks like some sort of startup index against the S&P 500 that was in the FT, and it shows pretty clearly that these are sort of correlated. So the better the stock market does, the more the startups, and of course those, as you know very well, are correlated to a low interest rate environment. But interesting in that chart, in 2019, the startup one actually started ticking down a bit. And it had been a pretty heated environment in 18, 19. And there was some early indications that perhaps there's a bit of a slowdown in the startup world, whereas the S&P was still sort of going up a little bit. And I actually felt that in the market back then. I felt a bit of rationalization or slowdown, whichever way you want to look at it. And then COVID hit. And when COVID hit, you know, all bets were off, market crashed, and then corrected quickly, as we know. And same on the startup side, there's a big 3 months, 2 months where everybody just focused on their portfolio. Let's make sure everybody's okay. They have money, they have funding. But then when the helicopter money came about, all of a sudden, both the S&P and the startup market went for a crazy ride. And what's interesting in the chart is, at that point, the startup world diverged with higher beta, maybe to use a trading term, from the S&P 500. So the takeoff in the startup world became even more violently upwards compared to the S&P, which led to crazy valuations, very high valuations. Companies going from a 10 million valuation to 100 to a billion in a matter of months, rounds getting done, standing up sometimes at a conference, rounds getting done, Series Seed, and then 3 weeks later, Series A. And that was clearly unsustainable. Hindsight is always clearer than reality, but now, especially with hindsight, that is one that should have come to a stop, and it did. So now it's come to a stop, and I think that was driven by sort of the fintech valuations really correcting on the public side with some of the big publicly listed fintechs, and then that reflected now in 22, 23 in the startup fintech world. So we felt that. And 22, 23 was in many ways a year where we did a lot of cost rationalization, a lot of discipline came back. Now we're at the beginning of 24. Looking at the market today, it is not as dire as some may actually expect. In fact, there's a lot of dry powder still in the VC and PE community. So we actually see quite high valuations still, not as high as sort of 2021, but still quite high. Some rounds get done very fast. There's a lot of competition. I think different from 2021, it's not as crazy, for lack of a better word. Two, there's a bifurcation where if you're not perceived to be a hot startup or have really great traction, people step back a lot. So there's a bifurcation. I think that's the second thing. And then the third thing, I think the rate environment is different. So, I mean, if you do lending, that has implications. And, and the biggest implication I always like to talk about is if you do because, VC has long timelines. If you do a 2x over 10 years with zero interest rate environment around you, that's a 2x in real terms. If the risk-free rate is 5%, 1.05 to the power of 10 is something like 1.96, effectively 2. So a 2x return over 10 years when the rates are at 5 is a 0% real return. So that's the big change. And I think not everybody has fully internalized that. But people are. And that doesn't mean that there's no opportunity. There's a lot of exciting opportunities. I think there's a lot of capital on the VC side. There's also a lot of capital, I think, on the bank side. So I think banks are getting pressure to deploy that into loan books. So I think anybody who has good loan originators will stand to benefit. We see some of that in a mini bubble building up in the sort of private credit side. People dancing in the streets and all these quotes I'm sure you heard about. So I think, it's a very interesting environment. It's not as crazy as 21, but it's also not doom and gloom. A lot of excitement, a lot of high valuations still.
Interesting. Yeah. And because you mentioned it, and I'm not familiar with that actually, is the liquidity cycle of a fund itself. I guess you have proper special funds, so you open for a basket of company and you raise for that. Yeah. How does it work? Can you, for who is less familiar, explaining what is the liquidity cycle in a less liquid asset class? How does it work?
Yeah. I mean, the liquidity cycle is very different, as you point out. And that's something that I'm still internalizing, having been here 7 years. And you could argue that the best time to internalize it is probably 7 years into a journey. That's when one feels it particularly sharply. But it is interesting. So some of our biggest winners, whether it's Nubank in Brazil or Credit Karma in the US, we invested in some cases for a couple of years. It looked good, but it wasn't clear that they're going to become the sort of giant multi-billion companies. Just for reference, I think we sold Credit Karma for close to 8 billion into its stock, and then Intuit went up, and I think it became like 9 billion effectively or something like that. I can't remember the exact numbers. And Nubank now is public, and I don't remember their exact market cap, but I think it's something in the 40 billion, 50 billion range. And that was in a 10-year horizon, all worth zero because it was just an idea not so long ago. And that is sort of the cycle that I think about is about 10 years. And if you think about that from a fund perspective, is when you invest in a fund, whether you get carry or whether you're an LP or you have both like we do, one should sort of count on a 10-year horizon. And that's longer than PE, certainly very different than liquid assets and hedge funds. And there's pros and cons in that. So I was joking earlier that some of my friends that work in hedge funds are jealous because, they think that we can hide behind illiquid markets for very long. On the other hand, I'm sometimes jealous of them because they get their feedback very fast if they've succeeded or not. We have to wait 10 years sometimes to know if we succeeded. So I think there's lots of pros and cons, but the main takeaway is it takes time. And that's by design, because to build, getting a billion valuation is relatively easier because one person can decide to value 2% of your stock at that valuation and give you a small check. But doing a multi-billion exit is much harder. Now, we have had many of those. We've had many multi-billion exits, so we've been very fortunate. But it takes time and it's not easy. And there's a quote a good friend of mine used to use, which is, there's this sort of crossing the chasm moment where you got to click send on the money and the money goes. And that applies to exits too. So if you're doing an IPO, at some point, all those investors will hand over hundreds of millions of dollars to that listing in the public markets. And that's a real moment of truth. And getting there requires a lot of performance to underpin that. And that performance means that it has to be stable, predictable, money-making ideally. There was a little bit of a problem in 2021 that a lot of the public companies were actually not profitable. And that's kind of changing now. So yeah, that's the sort of long answer to that question.
No, very, very clear. Maybe one last question. As I said before, I was browsing on your website and I see this name, Monty Morris. Who's Monty Morris? Can you tell us that?
Monty Morris. No, we love our dogs, and many of our partners and investment professionals and colleagues have the dogs at home. So Monty is our dog, and yes, we don't have one in the London office yet, but maybe it's time we actually get a pet for the London office too.
Fantastic. It made me laugh actually when I go through the people. I seen the dog as a CEO, canin executive office.
Yes.
Was amazing. Yeah. Well, thank you very much for your time. I think
Thank you.
our
My
time
pleasure.
is up. Thank you very much, and I hope to see you soon again back here.
Hopefully.
Thank you very much.